Frank Partnoy and Jesse Eisinger had a terrific piece in The Atlantic. It's called What's Inside America's Banks. And in it, you see some devastating facts. First of all, Americans get it. They don't trust the banks. In fact, only 21% of respondents said that they have faith in banks. Now, of course, again, among our powerful people in New York and Washington, the politicians and the media, they say, oh, the banks have some issues, but, you know, they're rock solid, and we did the stress test, they're fine. Well, we're not buying it, and we're right, as you're about to see. But what's interesting is that, okay, fine, the American people aren't buying it, but neither are the investors. Now, these are the guys on Wall Street, and they don't want to invest in the banks, because they call the banks big black boxes, meaning we have no idea what's inside. In fact, 79% of investors have no trust in the financial system. Isn't that amazing? 79% of investors don't believe in the banks. All right. Now, it's not just investors, it's not just the American people, it's actually the people who worked at the banks too. Let me give you a list here. Philip Purcell, ex-CEO of Morgan Stanley and Dean Witter. Or I should say Morgan Stanley, Dean Witter. Sally Krawcheck, ex-CFO of Citigroup. David Kamansky, ex-CEO of Merrill Lynch. John Reed, former CEO of Citigroup. Sandy Weil, legendary former ex-CEO of Citigroup. Not necessarily in the right ways, but very well known, one of the top bankers in the country for a long time. They have called for a breakup of the big banks, tighter regulation, and a return to Glass-Steagall laws, because they all have been inside the banks, they run the banks, and they know they are loaded to explode. If you don't get them under control, if you don't break them up, they're going to destroy this economy. Now, how about Don Young? He's the Financial Accounting Standards board member. Now, this is a private group that's supposed to do the accounting standards for the banks. After having served on the board, Don Young says, quote, after serving on the board, I no longer trust bank accounting. Now, that's the guy in charge of bank accounting. He says, I looked at it, and you're crazy if you trust it, but he's not alone. Another board member of that same Financial Accounting Standards Board, Ed Trott, when asked, do you trust bank accounting? Said, quote, absolutely not. Gee, I wonder if they're set to explode. So the other thing that these writers did was they looked into Wells Fargo. Now, Wells Fargo is supposed to be the most conservative bank. Warren Buffett has large ownership interest in there, and it's usually heralded as like, boy, those guys don't take the kind of risks the other crazy bankers do. Oh, well, that's interesting. So they looked at their disclosure forms. Number one, they found out they were incredibly vague on purpose. Number two, once you got to the disclosures and all the different levels of transactions they make, it got scarier and scarier. So let me quote one part of the disclosure here. It talks about customer accommodation. Now, wait a minute. This is a huge profit center for them. How could customer accommodation be such a big profit center? Is it, hey, I helped a guy with his checking account and we made money off that? No. This is what they call setting the market. So they accommodate the customers by doing tremendous amount of trading of derivatives on their own so they can help set the market. In fact, they explain in their own disclosure forms, quote, customer accommodation trading also includes net gains related to market-making activities in which we take positions to facilitate expected customer order flow. Now, why is that so important? That might sound complicated if you don't know about these disclosure forms. Because they're saying, oh, no. We're just market making. You know, a guy or tremendous investor A would like them to do a deal with tremendous investor B, and we just simply make that deal happen. If that's all they did, that would be understandable. But they say, we're doing this to facilitate expected customer order flow. In other words, the customers have not asked for that trade. They're doing that trade on their own. And so if it blows up on them. But they have to find an excuse. They can't just go out there and say, oh, well, we're doing hundreds of billions of dollars, and as you're about to see in some cases, trillions of dollars worth of risky trades for the bank, by the way, also using customer money. They have to say, no, it's expected customer demand. It's a joke. And then the writers found out that there was 3 different levels of risk. Level 1 was understandable, level 2 got really scary, and level 3 was insanity. Let me explain. The bank's level 3 estimates are generated primarily from model-based techniques that use significant assumptions not observable in the market. Okay, let me decipher that one for you. So they say, all right, we got all these level 1 things, and we have some sense of how much they're worth. Level 2, we don't have as good a sense, we're kind of guessing. In this one, all this money that we have in these transactions, even though we tell everybody we're totally financially sound, we have no idea what they're worth. We use significant assumptions of not observable in the market. Not observable in the market means no one has any idea what they're worth. Now, if you make a bet with a friend of yours, and if you lose the bet, you don't know how much you're going to lose, that would be an issue. You could lose $10. You can't really lose $1,000, right? That really hurts you if you lost $1,000. But they don't know the size of these bets. And they're not betting $1,000. They're betting trillions. Okay, here we go. Now, in the past, companies like Enron did these tricky accounting things to levels 1 through 3 or at least are on the books, but they want to do some off-the-books transactions, okay? So they came up with a word for it, special purpose entities. Okay, you can tell in the name, right? It's a special purpose entity. The special purpose is to cheat, okay? Because I want it off my books, because if you saw it on my books, you would immediately realize I'm committing massive fraud. Okay, so now they don't do that, that's discredited. They changed the words, doing the same exact thing, but it's now called variable interest entity. So it's off the books, it's not even level 3, it's worse than level 3 risk. And what's the interest? It's a variable interest entity. Okay, but you're thinking, okay, but these guys have a lot in reserve. For example, Wells Fargo has, over $140 billion of cash in reserve. That sounds like a lot, right? Well, it's not so much when you find out just their variable interest entities' total assets are $1.46 trillion. That's the stuff that's off the books. $1.46 trillion. Now, if you don't know exactly what you owe and exactly what you own when you're making bets off of $1.46 trillion, if it goes a little wrong, what do you think happens to your bank? And when Wells Fargo goes down, then all the banks that are connected and betting with Wells Fargo, they also go down. And here's something really scary that's not in the article that I know from other articles that I've read. All the companies now do 30-day borrowing. Now, why is that obscure fact important here? It's short-term funding. If the banks go under, all the companies immediately run out of money. They can't pay their vendors, they can't pay their employees, they can't pay anything because there's no one to lend them the 30-day money. Oops. These guys are going to drag the entire global economy down with them. I haven't even gotten to the worst part. Now, Wells Fargo actually does twice as much derivatives trades as it does variable interest entities. It does $2.8 trillion in its derivatives. $2.8 trillion. Now, derivatives are what blew up the economy last time around in 2008. Now, finally, if you think that's bad, remember how I told you that Wells Fargo is actually the most conservative bank. Okay, this is the crap you find in the most conservative bank. You ready for a bank that is often praised? JP Morgan. My God, these guys, they got to figure it out. Recently, they had a $6 billion blow up on derivatives trading. And everybody was like, oh my God, Jamie Dimon, who runs JP Morgan, I can't believe he had any errors at all. Oh my God. Well, that's probably the worst of it. Do you know how much in notional derivative trades JP Morgan has? $72 trillion. That is 5 times the size of the US economy. Now, they will argue, hey, listen, that's the notional value. That doesn't mean that the whole $72 trillion is at risk. You know, we've got bets on one side, we got bets on another side. You can't lose them all. So not the entire $72 trillion is at risk. Only a percentage of it is. Oh, that's so comforting. So maybe only $7 trillion is at risk. What difference does it make? It's 5 times the US size of the US economy. Any little error could cost them tens of billions of dollars, perhaps $100 billion. Any little error if they get it off by this much. And some of these transactions I told you are off the books anyway. The others, they don't even know what the hell the market rate is. There is no market rate. It's not observable. Anybody who reads this, and the authors of the article came to the same conclusion, we are in a world of hurt. We have not fixed a damn thing. These guys are still completely and utterly out of control. And an explosion that is centered around the banks is inevitable. I mean, the idea that we could fix this in time is a joke. Nobody's even trying to fix it. So will they make a mistake, one of these guys at one of these banks, that then leads to a cascading series of errors and bets that can't be paid? Absolutely. Write it down in stone. These banks are going to collapse. They're going to collapse the U.S. economy with it, and almost the entire world economy. Probably at the end, they'll ask for a bonus.